to an Welcome back to another Principles of Business lecture. Today we'll be looking at nature of business, and our subtopics are instruments of exchange or payments and some terms and concepts related to business. Let us start with our objectives for this lesson. We are going to list and define the major instruments of payment and define and explain some terms and concepts related to business. So let us start looking at our instruments of payment. We have a long list of instruments of payment to look at today. Number one is our bills of exchange. Bills of exchange is an unconditional order in writing. It is issued by a person or business and directs the recipients to pay a sum of money to another business or person at a future date. So a bill of exchange is a order that is written, right? So the business will say to a recipient that a sum of money should be paid to another business at a future date, right? Our second instrument of exchange is the electronic transfer. And we are very used to this type of instrument of exchange because it is common even today, right? So it says the electronic transfer of money from one bank account to another. This can be done without a single financial institution or across multiple institutions using computer based systems without the use of direct intervention of bank staff. All right. So even today, your parents may have online banking, right? And on their phones, they will send some money from their account to your account. So this is electronic transfer of money, right? So you don't have to go to the institution to send the money. You can do that online. And this have become even more common due to the COVID-19 or the pandemic because at that time we had limited access to the banks. So we were told to use online banking, where we would have done electronic transfer of money as well as paid other bills through the app on our phone, right? We have it for NCB, we have it for Scotia. Nearly most every bank has the online banking where we can do electronic transfer, right? Another instrument of exchange is telebanking and e-commerce, right? So telebanking is somewhat similar to what we were just looking at because this is a banking service that is offered by the telephone, right? Telebanking includes access to one's checking and savings accounts, being able to see balances and make transfers, among other things. So, just as we were saying about NCB, you know that they have their app as well as Scotia and other banks. They have their app, and you are able to access your balances. You can check your balance. You can see when individuals or businesses send you money into your account, or you can see when money is taken out of your account, and anything that happens to your account you can also see it, right? You can also make transfers, among other things, right? This is a very convenient way as bills can be paid on time and the individual does not have to join lines at utility companies or to pay within business hours, right? So you can do transactions on your phone at any time, right? When it comes on to banking, it is normally done from Monday to Friday for you to go to banks. But most people work from Monday to Friday. So telebanking is convenient since persons don't have to leave their work to pay bills. They can just do it from their phone. They don't have to join the lines and wait the long hours. They just can do it from their phone. So this saves time and this is also very convenient for most individuals. Instead of a receipt, you receive a transaction reference number as a proof of payment. First time users may find it difficult to use this system. So that would be the only disadvantage of the telebanking and e-commerce, because older persons as well as first time users may find it very difficult to use. But if they learn, then they will find that it's actually easier than going to the bank to join the lines, right? Number 4 says checks, and everybody is used to checks. It is becoming less common now. More people are using different methods because most people don't want to handle the check, but it is still around and it is still using, right? A check is an instrument by a drawer, and the drawer is the person who is writing the check to a bank. So the person at the bank is the drawee, and the drawee pays on demand a specified sum of money to the payee, so the person being paid, by taking the sum from the payer's account. Right? So a check is an instrument by a drawer to a bank to pay on demand a specified sum of money to the payee by taking the sum from the payer's account. So basically, if John Brown has a business and John Brown had a worker and the worker's name is Tom. So John Brown wants to pay Tom his money, but John Brown writes a check to the bank to pay Tom. On the check, John Brown puts $2,000, right, to pay to Tom. Tom would be who? Would Tom be the drawee, the payee, or the drawer? Tom would be the payee because Tom is the person collecting the money. Who would John Brown be? John Brown would be the drawer because John Brown is the person who is writing the check. And who would the teller be? The teller who is at the bank would be the drawee. Right, so that's some simple things about the check. Number 5 says money order. So what is a money order? A money order is a paper document similar to a check that is used as a form of payment. So a money order is somewhat like a check, right? A money order is bought by prepaying the amount printed on the face of the document with cash or other form of guaranteed funds. The information on the money form is then filled out, right? So this would be a money order. So it's somewhat similar to a check, but the thing is that the money is paid, it's prepaid first, and then the whatever money you will, for example, you pay $2,000 for the money order. The person who you're buying the money order to will write it up and write who's supposed to get it, etc. And then the person who gets it will get their $2,000 when they bring it to the bank. Number 6 is debit cards. A debit card is a payment card that deducts money directly from a customer's savings or checking account to pay for a purchase, right? So a debit card is a payment card. So you get debit cards usually from banks, and what they do is that you're saving, right? You have a saving account and or a checking account. And whenever you decide that you want to buy goods at or do any transaction that requires payment, you can use your debit card to pay. Now, this removes the need for you to carry large sums of money around with you because you know that times are getting serious and you don't want to carry too much money on you so that you can meet in any robbery, right? So a debit card allows the user to go into debt as they does not allow the user to go into debt as they have spending limits, right? Debit cards may or may not have a personal identification number, which is a PIN. Most debit cards have a PIN. When you go to the ATM machine, you will type in your PIN first before you can do any transaction, right? Using a debit card at certain ATM machines can cost a fee if the ATM is not affiliated with your banking institution. So, if you have a debit card at Scotia and probably you use it at um, another bank that is not affiliated with Scotiabank, then it will cost you some money, but not a lot of money, but still some money. Number seven says credit cards. So credit cards are somewhat similar to debit cards, but the difference is that this card, right, it is not taken from money that you are saving, right? It's like you're borrowing the money from the bank and then you have to pay back that money with interest, right? So a credit card is issued by a bank and allows cardholders to borrow funds to pay for goods and services. Cardholders must pay back the borrowed money plus any applicable interest in full by the billing date or over time. Some credit cards allow customers to borrow cash through the ATM or teller. This is normally at a higher rate, right? Number eight, bank draft. Now, a bank draft is a check which you can buy from a bank in order to pay someone who is not willing to accept a personal check, right? So some persons, they're not sure that you have the money to issue them a check. So they would rather get a bank draft where they are given some more assurity that they can they are going to be paid that sum of money when they go to the bank. Now, a bank draft is a promise of money of payment, similar to a check that is issued by a firm payable at some future date, guaranteed for a fee by the bank that stamps it accepted. Right? Number nine says bank transfer. So a bank transfer happens when a person instructs their bank to send money directly into another bank account. Right? So, for example, I have an aunt and I want to send her some money. She has a Scotia account. I have a JN account. This is bank transfer because it's not the same bank. So what we do is that the money is sent from my JN account to my aunt's Scotia account, right? Now, this is usually done electronically via online banking. Persons usually receive the funds no later than 24 hours after the time the transaction was placed. But you can also do this transaction physically when you go to the bank. Number 10, telegraphic money. Now, telegraphic money is also known as telex transfer and is a term used to refer to an electronic means of transferring funds. A transfer of charge is often charged by the sending bank, in some cases by the receiving bank. Alright, so you transfer funds through the telegraphic money. And what happens is that sometimes the receiving bank may charge, or the sending bank may also charge. Alright? Number 11 is mobile money or mobile wallet. Right? And this is not yet very common, but it is common within some countries in Africa and China. And also it is somewhat common in China. Now, this is a fast, secure, and convenient way to receive, store, spend, and send money using a mobile phone. Right? So it's a fast, secured, and convenient way to receive, store, spend, and send money using a mobile phone. Mobile money is an electronic wallet service and is available in many countries. So now we're going to look at 6 business terms and concepts which will come up within your study of principles of business and in any study of business, right? In any area. So we're looking at trade versus bartering. So what is trade and what is barter? Trade is the voluntary exchange of goods and services between two economic persons, institutions, or nations. So trade is a voluntary exchange, right? And it can be involves two persons, two institutions, two business, two organization, or it can also involve different countries. So you'll hear of Jamaica sending bananas to the different parts of the world, and other countries sending we're importing and exporting. So that is trading. Barter now is actually a type of trade, right? Because it involves the voluntary exchange of goods and services. But it is the exchange of goods and services without the use of money. So that's the difference between barter and trade. Enterprise and entrepreneurship, right? An entrepreneur is one who organizes, manages, and assumes the risk of setting up a business or enterprise. So, once you set up a business, no matter what the business is about, you are a entrepreneur. So, most people used to think that entrepreneurs can only set up shops, they can only set up clothes store, they can only set up um like baking, what you call those bakeries, etc. But entrepreneurs are becoming even more creative and they are setting up business ideas that no one would have thought about before, right? So we have entrepreneurs setting up businesses online who are setting up businesses where they can control social media posts, where they can also join affiliate marketing. So the world is becoming more innovative. And so entrepreneurs have a wide variety of businesses that they can set up. An enterprise now is a for the profit business, right? So it's started and run by an entrepreneur, and it is any business that is run mainly for profit, right? Our last 2 terms are profit and loss. So what is profit? Profit is the money earned by a business when its total revenue exceeds its total expenses, right? So profit is earned when a business's total revenue exceeds its total expenses, while loss is the money lost by a business when its total expenses exceeds its total revenue. So when the revenue exceeds the expenses, then it's profit. And when the expenses exceed the revenue, then it is loss. Thank you for watching. I hope you'd have learned something new this session and that you will continue to watch and subscribe to my channel. Bye.